Imagine waking up tomorrow and realizing that most of your life decisions were never really yours. Where you live, what job you take, how long you work, what risks you can afford to take. Not because someone put a gun to your head, but because of numbers on a screen. Here's the mystery. Debt is sold to us as freedom. Education loans are called investment in yourself. Mortgages are framed as stability. Credit cards promise convenience. And yet across history, wherever debt becomes widespread, power quietly concentrates, freedom narrows. And entire populations become predictable, manageable, and obedient. So how did debt evolve from a temporary tool into the most effective system of control ever created? And why does it feel invisible while shaping almost every modern life? To answer that, we have to go back long before credit scores, banks, or even paper money and follow the chain of cause and effect that brought us here. Long before modern finance, debt already existed, but it wasn't abstract. In ancient Mesopotamia, debts were measured in grain or silver, and they were deeply personal. If a farmer couldn't repay, the consequences were immediate. Land seizure, forced labor, or even debt slavery. Entire families could be absorbed into servitude because of a bad harvest. Rulers quickly noticed something important. Excessive debt didn't just ruin individuals, it destabilized society. When too many people fell into bondage, revolts followed. Now, that's why some ancient kings periodically declared debt jubilees, wiping the slate clean. Not out of kindness, but survival. Debt had power, and unmanaged, it threatened the system itself. Fast forward to medieval Europe, debt becomes tied to land, crowns, and war. Kings borrowed heavily to fund armies. When they couldn't repay, creditors, often banking families, gained political leverage. Power quietly shifted from swords to ledgers. Control no longer required conquest. It required contracts. The twist is this. Debt didn't become truly dominant until it was detached from morality and survival and embedded into institutions. That shift accelerates with the rise of modern banking. Fractional reserve systems allow banks to lend far more than they actually possess. Money's no longer scarce. It's credit, created through debt. Every loan creates new money, but that money must be paid back with interest that doesn't exist yet. This is the moment debt stops being a personal obligation and becomes a structural necessity. Governments begin borrowing not just in emergencies, but as standard practice. Citizens are told this is normal, necessary, even responsible. National debt grows, but instead of being seen as a warning sign, it becomes invisible background noise. Then comes the real breakthrough in control: consumer debt. In the early 20th century, buying on credit was considered shameful. You either had the money, or you didn't buy. That cultural resistance was a problem for manufacturers. Factories could produce more than people could afford. The solution wasn't higher wages, it was financing. Advertising reframed debt as progress. By now, pay later wasn't a trap, it was opportunity. Desire no longer needed to wait for income. Consumption became detached from production. Cause and effect kicked in fast. More credit led to more consumption. More consumption required steady income. Steady income required stable employment. Stable employment required obedience. Debt quietly disciplined behavior. Then came the breaking point, the Great Depression. Easy credit, inflated bubbles. When they burst, millions lost jobs but not their debts. The system revealed its asymmetry. Profits were private, losses were social. The response wasn't to abandon debt, was to formalize it. Central banks gained power, monetary policy replaced direct accountability. Instead of asking whether the system was fair, leaders focused on keeping it functional. Debt was no longer a flaw, it was a lever. After World War II, the system expanded globally. Developing nations were offered loans for growth, infrastructure, modernization, development. But the loans came with conditions: structural adjustments, austerity, resource extraction. Debt became geopolitical control. Countries that couldn't repay lost autonomy. Their policies were dictated by creditors. Social spending was cut, wages stagnated, assets were privatized. The population paid the price, not the decision makers. Now bring the story closer to home. In the late 20th century, wages stopped rising with productivity. Instead of addressing that imbalance, debt filled the gap. Student loans replaced affordable education. Mortgages replaced accessible housing. Credit cards replaced savings. This wasn't accidental, it was adaptive. When people are debt-free, they can walk away. When people are indebted, they comply. They stay in jobs they hate. They tolerate conditions they shouldn't. They avoid risks that could threaten income. Debt doesn't need force. It creates self-regulation. Then comes another breaking point, the 2008 financial crisis. A system built on debt collapsed under its own weight. Trillions evaporated. But once again, the pattern repeated. Debts were socialized. Banks were rescued. Individuals were not. The message was subtle, but clear. The system must survive, even if people don't thrive. What followed was not reform, but expansion. Interest rates dropped to near zero. Cheap money flooded markets. Asset prices soared. Those with assets benefited. Those without took on more debt just to keep up. This leads us to the present moment. Today, global debt exceeds global GDP by a wide margin. Entire generations begin adulthood already behind. Education, healthcare, housing basic, pillars of life, are accessed through lifelong repayment. The shocking part isn't the numbers, it's the repetition. Every cycle follows the same pattern. Debt is introduced as a solution. It becomes normalized. It concentrates power. It breaks. Yes. The fixes protect the system, not the people. And the cycle restarts at a higher level. Technology has only refined the mechanism. Credit scores quantify obedience. Algorithms decide who deserves opportunity. Missed payments become digital scars. Control is automated. And yet debt still wears the mask of freedom. So what does all this mean? Its first takeaway. Debt is not just an economic tool, it's a behavioral system. It shapes choices long before force is ever needed. Second takeaway. When debt becomes essential to survival, freedom becomes conditional. Not removed, but rationed. Third takeaway. Systems built on perpetual debt require perpetual growth. When growth slows, pressure moves downward onto individuals. Here's the warning. A society that normalizes lifelong indebtedness eventually forgets what genuine choice feels like. When every decision is filtered through repayment risk, imagination shrinks. Innovation slows, dissent fades. The most effective control systems don't look like oppression. They look like responsibility. And the open-ended question is this. If debt is the invisible architecture of modern life, what happens when people finally see it not as a personal failure, but as a designed system? Because once something becomes visible, it stops being absolute. If this video helped you see the bigger pattern behind everyday financial pressure, consider liking it to signal this conversation matters. Subscribe if you want deeper, historically grounded explanations of systems we're told not to question. And share this with someone who feels trapped but can't quite explain why. Sometimes, understanding the mechanism is the first step toward loosening its grip.